Welcome back to the grey metal. Silver just crossed $100 per ounce for the first time in history. But while retail investors are celebrating the triple-digit milestone, something far more consequential is unfolding beneath the surface. In procurement departments, refinery boardrooms, and industrial supply chains across the globe. Over the next 30 days, a series of decisions will be made that could determine whether silver stabilizes around current levels or surges toward $130 and beyond. This isn't about hype or sensational predictions. This is about understanding the structural forces that move commodity markets during periods of acute supply stress. I'm going to walk you through the industrial demand landscape, the refinery capacity constraints, the procurement cycle dynamics, and why the next month represents a genuine inflection point for silver. This is the grey metal. Let's break it down. It's late January 2026, and silver is trading at approximately $99.50 per ounce in New York and $111 in Shanghai. That $11.50 premium in Shanghai isn't just interesting, it's a critical signal. For context, the average Shanghai premium over spot New York pricing has historically ranged between 50 cents and $2 per ounce. During periods of tight supply, it might stretch to $3 or $4. An $11.50 premium indicates something fundamental, is diverging from paper market pricing. But here's what most retail investors and even many professional analysts are missing right now. The real story unfolding in the silver market isn't happening on COMEX futures or the Shanghai Futures Exchange. It's happening in places most people never see. Procurement meetings at Tesla, Samsung, First Solar, LG Energy, Trina Solar, and dozens of other industrial manufacturers. And what these companies are dealing with right now is a problem that cannot be solved simply by paying higher prices. Let me explain what I mean. To understand where silver is headed, you need to understand who's buying it and what happens if they can't get it. Tesla's 4680 battery cells represent a significant technological advancement in EV battery design. These cells use silver-coated current collectors to improve electrical conductivity and reduce charging times. Industry estimates suggest that Tesla's 4 major gigafactories, Texas, Nevada, Berlin, and Shanghai, will consume 90 to 110 million ounces annually at full capacity, representing roughly 12% of global mine supply. Tesla isn't alone. Other EV manufacturers are ramping production globally, and many are adopting similar battery architectures that require significant silver content. Samsung is heavily invested in next-generation solid-state battery technology. The challenge? These batteries require substantially more silver per unit than conventional lithium-ion designs. Their 2027 production targets suggest annual requirements of 120 to 150 million ounces. When you combine Tesla and Samsung's requirements, you're looking at roughly 25 to 30% of annual global mine production being consumed by just 2 companies. The solar photovoltaic industry remains the single largest industrial consumer of silver worldwide. Each standard solar panel uses approximately 20 grams, or 0.64 ounces, of silver in the form of conductive paste applied to silicon wafers. The global solar industry currently consumes 130 to 150 million ounces of silver per year. First Solar, America's largest panel manufacturer, produces roughly 10 million panels annually, translating to approximately 6.4 million ounces of silver consumption. But First Solar is expanding aggressively. New manufacturing facilities in Ohio and India, scheduled through 2027, could triple their silver requirements to nearly 20 million ounces per year. The solar sector is growing at 12 to 15% annually, driven by climate policies, renewable energy mandates, and the economics of grid-scale solar deployment. When you aggregate all industrial demand, automotive, solar, electronics, telecommunications, medical, and defense, you're looking at approximately 500 to 550 million ounces of annual consumption. Global silver mine production is roughly 830 million ounces per year. At first glance, that seems adequate to cover 550 million ounces of industrial demand. But that remaining 280 million ounces needs to serve investment demand, jewelry manufacturing, silverware, and other applications. Investment demand alone, including bars, coins, and ETFs, has been running at 200 to 250 million ounces annually. The math doesn't work. The market is structurally tight. Let's talk about why $130 per ounce matters, and to do that, we need to understand the economics of solar panel manufacturing. A typical residential solar panel sells for approximately $200 to $250 at wholesale pricing. Manufacturing costs, including silicon wafers, aluminum framing, tempered glass, junction boxes, assembly labor, and overhead, run between $170 and $190 per panel. That leaves a gross margin of roughly $30 to $60 per panel, representing a 15 to 25% margin. Now let's look at what happens to those economics as silver prices rise. At $99 per ounce, the silver content in one panel, 0.64 ounces, costs approximately $63. At $110 per ounce, that rises to roughly $70. At $130 per ounce, the silver alone costs $83 per panel. If base costs are $180 and silver hits 83 tons, total cost reaches $263, above the $250 selling price. The economics break. Solar manufacturers face three options, none of which are good. Option 1. Absorb the cost increase, eliminate all profit margin, and operate at break-even or loss. Option 2. Raise panel prices to $300 or higher, which destroys demand and makes rooftop solar installations uneconomical. Option 3. Reduce silver content through metallization innovation, but this requires 12 to 18 months of research, development, and production retooling. In the short term, manufacturers don't have good options, and this is why $130 matters. It's not an arbitrary target, it's the approximate threshold where solar panel economics fundamentally break down under current manufacturing processes. But different industries have different breakpoints. Solar manufacturers might struggle at $130. EV battery manufacturers might absorb costs up to $150. Electronics manufacturers might remain viable to $175 or higher because silver represents a smaller percentage of total product cost. This creates what I call the sequential stress pattern, where different sectors come under pressure at different price levels, creating a stair-step effect as silver moves higher. Here's a critical concept that most silver market analysis completely overlooks. Mine supply is largely irrelevant in the short term. What matters, especially during periods of demand surge, is refining capacity. Refined silver is what industrial buyers actually need. They can't use raw ore. They need deliverable bars, granules, powder, or industrial-grade silver that meet specific purity standards. And right now, global silver refining capacity is running at near maximum utilization. According to industry reports, delivery lead times for refined silver have extended from the normal 4 to 6 weeks to 10 to 14 weeks in some markets. Why can't refineries just increase output? Because refining is a capital-intensive, technically complex, chemically sensitive process with fixed throughput constraints. You can't simply run a refinery 20% faster by working overtime. The chemical processes take the time they take. The equipment has maximum capacity limits. Quality control can't be rushed. When industrial buyers panic and attempt to order 2 or 3 quarters worth of inventory simultaneously, refineries hit a hard capacity wall. And that capacity wall is what transforms price pressure into price explosion. When buyers realize they can't get the physical metal they need at current prices, with acceptable delivery timelines, they start competing on price. We'll pay $5 over spot for priority delivery. Then another buyer offers $10 over spot, then 15s, and as physical premiums rise, spot prices inevitably follow. This is the mechanism through which translates into vertical price movement. Now let's talk about why the next 30 days specifically represent a critical period. Most large industrial manufacturers operate on quarterly procurement cycles. Purchase orders for Q2, covering April, May, and June, are typically finalized and submitted in late January and early February. Right now, as we speak, procurement teams at major manufacturers are making decisions about Q2 silver orders. But this procurement cycle is different from normal. Given the price surge from $75 per ounce in December to $99 today, many companies are adopting defensive procurement strategies. Instead of ordering exactly what they need for Q2, they're requesting 150 to 200% of normal volumes to build buffer inventory against further price increases and supply disruptions. Let's work through the mathematics. Normal quarterly industrial silver demand is approximately 140 million ounces. If companies are ordering at 200% to build safety stock, that's 280 million ounces of orders hitting global refineries over the next 30 days. But global quarterly refining capacity is approximately 200 to 210 million ounces. That's a 70 to 80 million ounce shortfall between orders and fulfillment capacity. What happens when orders exceed capacity? Refineries begin prioritizing orders based on existing contract relationships, customer payment history, and, increasingly, price. Buyers offering higher premiums get priority placement in the production queue. This creates a bidding dynamic where price becomes the mechanism for rationing scarce refining capacity. And critically, once this bidding process begins driven by it tends to accelerate. No procurement manager wants to explain to their executive team why production lines shut down because they didn't secure silver supply. The cost of paying $10 or $15 over spot is trivial compared to the cost of halting manufacturing operations. So buyers keep bidding higher, and spot prices keep rising to reflect the premium buyers are willing to pay for available supply. China plays a unique and critically important role in the global silver market. China is simultaneously the world's largest manufacturer of silver-intensive products and one of the world's largest consumers of physical investment silver. Approximately 85% of global solar panel production happens in China. Much of the world's electronics manufacturing is based in China. Chinese companies are major players in battery production. At the same time, Chinese retail investors have a strong cultural affinity for physical precious metals. Silver bars and coins are widely held as savings vehicles. This creates a powerful feedback mechanism. When Chinese manufacturers begin aggressively buying silver to secure supply for production needs, Chinese retail investors notice. They interpret manufacturer buying as a signal of impending shortage and begin buying silver themselves as an investment. This additional investment demand further tightens physical supply, which drives the Shanghai premium higher. That 1150 premium we discussed earlier, that's the feedback loop in action. As the Shanghai premium widens, it creates arbitrage pressure. If silver is $99 in New York and $111 in Shanghai, traders have an incentive to buy in New York and sell in Shanghai. But physical delivery takes time. Shipping, customs, refining to meet Chinese purity standards, the process takes weeks. During that delivery window, if demand continues accelerating, the premium can widen further rather than narrow. If the Shanghai premium expands to $20 or $25 per ounce, it effectively pulls New York spot prices higher, overwhelming paper market structure. This is why China isn't just another market participant, it's an amplification mechanism that can accelerate price moves in both directions. There's another dynamic we need to discuss, the shift from just-in-time procurement to strategic stockpiling. For the past 2 decades, industrial supply chain management has been dominated by just-in-time inventory practices. Companies minimized warehouse costs by ordering only what they needed for immediate production, with frequent small orders rather than large stockpiles. This works when supply chains are stable. It fails catastrophically when supply becomes constrained, when industrial buyers realize that silver availability is genuinely uncertain, that they might not be able to get what they need when they need it. They don't just buy for next quarter. They buy for the next year, or 2 years. Let me give you a concrete example. If Tesla normally operates with 90 days of silver inventory and decides to increase that to 365 days as a strategic buffer, that's an incremental 270 days of inventory they need to acquire. At 110 million ounces of annual consumption, 270 days equals roughly 81 million ounces of additional demand, purchased not over time, but as quickly as possible. Now multiply that behavior across 20 or 30 major industrial buyers making similar decisions. You could see 500 million to 1 billion ounces of hoarding demand emerge over a 6 to 12-month period, more than an entire year of global mine production. This is what's called a hoarding spiral in commodity markets. It's what happened with palladium in 2000-2001, when automotive manufacturers panicked about supply for catalytic converters. It's what happened with rare earth elements when China threatened export restrictions. And it could happen with silver if industrial buyers conclude that securing long-term supply is more important than managing short-term costs. The challenge is that once a hoarding spiral begins, it's extremely difficult to reverse. Even if mine production increases or demand from some sectors declines, the inventory that's been hoarded stays hoarded. Companies that built 18-month stockpiles aren't going to draw them down just because prices stabilize. They'll maintain those buffers because the original uncertainty hasn't disappeared. There's one more factor we need to consider: government procurement. The United States military is a substantial consumer of silver for defense applications. Silver is used in missile guidance systems, radar components, avionics, satellite electronics, and various weapons systems. Defense procurement operates under different rules than commercial procurement. The Department of Defense has authority under the Defense Production Act to prioritize its orders and, if necessary, require suppliers to fulfill government contracts before commercial orders. Defense spending isn't discretionary. The military doesn't cancel weapon systems because silver got expensive. They pay whatever it costs and, if necessary, use regulatory authority to ensure they get priority access to supply. When government buyers enter bidding competition with private sector buyers, it fundamentally changes market dynamics. You cannot outbid a government that has both unlimited financial resources and regulatory authority to prioritize its orders. Private sector procurement managers understand this. If they believe the government is beginning to stockpile silver for strategic reasons, it intensifies their own urgency to secure supply before government buying makes it even more difficult. This creates yet another acceleration mechanism in an already tight market. Now, let's be rigorous and consider what could prevent silver from reaching $130. If silver prices rise high enough, fast enough, some industrial applications become uneconomical and demand declines. Solar panel manufacturers might temporarily shut down production. Some electronics manufacturers might accelerate substitution efforts. Reduced demand would ease pressure on refining capacity and potentially stabilize prices below $130. Engineers are constantly working to reduce silver content in industrial applications. Copper, aluminum, and other conductors can substitute for silver in some applications, though usually with performance trade-offs. If technological breakthroughs enable significant silver reduction in solar panels or batteries, it could fundamentally alter the demand equation. Higher silver prices make recycling more economically attractive. Electronics recycling, photography equipment recovery, and industrial scrap processing could increase the effective supply of refined silver without increasing mine production. If global economic growth slows significantly, demand for EVs, solar panels, and electronics could decline, reducing industrial silver consumption. Higher prices incentivize increased mining production, though this takes 2 to 5 years to materialize due to the time required for exploration, permitting, and mine development. Any or all of these factors could prevent silver from reaching $130, or could cause it to peak and reverse before hitting that level. Markets are dynamic systems, not predetermined trajectories. But if we assume the current supply-demand dynamics continue, here's the likely pathway to $130. Refineries inform customers of extended delivery times, 14 to 16 weeks instead of the normal 6 to 8 weeks. Buyers begin offering premiums for priority delivery. Physical premiums in Shanghai and other markets widen further. Spot prices rise from $99 to $105 to $110 as futures markets begin pricing in physical tightness. Refineries formally notify customers that they cannot fulfill orders as requested. Some orders are partially filled, others are pushed to Q3 delivery. Industrial buyers realize the shortage is real and begin placing orders for Q3 and even Q4 to secure future supply. This additional forward buying adds another 100 to 150 million ounces of orders to an already overwhelmed refining system. Spot prices push through $115 and approach $120. Q2 production begins, and manufacturers with insufficient silver inventory start experiencing supply constraints. News reports emerge of production slowdowns at solar manufacturers or electronics firms. This triggers broader awareness among industrial buyers that haven't yet acted, creating another wave of panic buying. Chinese manufacturers and investors accelerate buying, widening the Shanghai premium to $20 to $25. Arbitrage pressure pulls COMEX prices toward Shanghai levels. Spot prices break through $125 and approach $130. Silver reaches $130 not as a final destination, but as a clearing price, the level at which the most desperate buyers are willing to pay, and some marginal demand begins to decline. At $130, some solar manufacturers pause production. Some electronics firms accelerate substitution projects. Some speculative investment demand pulls back. Supply and demand reach a temporary equilibrium, and price volatility increases as the market searches for a sustainable level. This is the pathway. Not inevitable, but plausible given current dynamics. If you own physical silver, understand that you're holding an industrial commodity during a period of potential supply stress. Your upside comes from industrial panic, not from retail investment demand. Your risk is that industrial demand destruction or substitution happens faster than you expect, or that the shortage narrative is less severe than currently believed. Manage position size accordingly. Silver is not a safe haven in the traditional sense. It's a volatile industrial metal with investment characteristics. If you're a procurement professional at a manufacturing company that depends on silver, the next 30 days require decisive action. Waiting to see if prices decline is a bet against the current supply-demand trajectory. Securing supply, even at elevated prices, is likely less costly than production disruptions or emergency spot market purchases later. Consider building strategic inventory buffers while refined silver is still available, even if delivery timelines are extended. Understand that commodity markets during shortage periods are characterized by high volatility, poor liquidity, and potential for rapid reversals. Silver could absolutely reach $130 or higher, but the path won't be smooth. Expect violent pullbacks, whipsaw moves, and periods where physical and paper markets diverge significantly. Use appropriate risk management and position sizing. We're at a genuine inflection point in the silver market. The next 30 days will reveal whether current supply-demand imbalances are temporary and manageable, or whether they're the beginning of a more severe and sustained shortage. The procurement decisions being made right now by industrial buyers will either stabilize the market or accelerate it toward $130 and beyond. The refinery capacity constraints are real. The industrial demand is real. The timeline pressures are real. Whether they culminate in a price spike to $130 depends on how evolves over the next 30 days, how buyers respond to uncertainty, how quickly demand destruction occurs at higher prices, and whether substitution or recycling can increase effective supply fast enough to matter. This is not financial advice. This is not a guaranteed prediction. This is an analysis of the structural forces currently operating in the silver market and the logical implications if those forces continue along their current trajectory. The grey metal is at a critical moment. The next 30 days will tell us which direction it's heading. If you value calm analysis over market noise, consider subscribing. We don't do hype, we do research. This is the grey metal. Stay informed, stay rational, and we'll continue tracking this story as it unfolds. Thanks for watching, and I'll see you in the next video.